Hello, and welcome to Credit Careercast, brought to you by Highako. Today, Dave Schmidt is joined by Brad Hibbert to discuss what every credit exec should know about third-party risk management. Make sure to also check out the corresponding article on Credit Today. With that, let's get into it. Over to you, Dave.
Hello, everybody. This is Dave Schmidt with Credit Today, and I'm glad to have Brad Hibbert from Prevalent join me. And we're going to be talking about what every credit executive should know about third-party risk management. And reason that this is a topic we want to delve into is credit managers are commonly being asked to do some financial analysis, other risk analysis, credit analysis, whatever, for suppliers and other third parties that the corporation might want to vet. And so corporate third-party risk management teams are calling on the credit folks to give them a little hand. And so we want to help you understand what's involved in all of that. So before we begin, Brad, can you just give us a little background on yourself and the Prevalent platform?
Yeah, sure. So my name is Brad Hibbert. So I've spent 25 years in doing different various roles within software and primarily focusing on security and cybersecurity and identity security and so forth. And a few years ago, what we found dealing with a lot of large organizations was that they're really having a difficult time, not just with their internal security of their internal systems, but really securing and mitigating the risks of the third parties that they were building their businesses around. And so I came over to a company called Prevalent a few years ago, and we're really focusing on helping organizations understanding those risks associated with those business relationships and how to best reduce those risks by making better risk-based decisions throughout the contract execution. So that's kind of where I'm at now, and certainly it's been an exciting couple of years here at Prevalent.
Terrific. So let's delve right into it. So, first of all, could you tell us a little bit about third-party risk? What do credit managers need to understand about it?
Sure. Well, as you know, more and more organizations are relying on third parties as they continue to focus on sort of their core competencies and keep up with sort of their strategic initiatives. Third parties are becoming more core to their business and more critical to their business. And when they onboard those relationships, they onboard a number of risks. And so third-party risk management is really the process of analyzing and minimizing the risks associated with outsourcing to those third-party vendors from a product perspective or those third-party service providers. And when you establish those relationships, of course, there's many different types of risks that can be brought into the organization. Everything from security, IT controls risks, financial risks, environmental and social risks, reputational risks, and so forth. And so, I think, there's a number of risks, and certainly financial stability and risk insolvency is a significant portion of third-party risk management lifecycle as well, and has some overlap, I think, with credit. Really, the analytics and consideration of financial across third-party risk management in credit analysis is really more comparative, where the focus for third party is more operational in nature. So what are the things that are impacting the business on an ongoing basis that could affect the revenue generating services, or that could impact the ability of a third party to perform their contract, or adhere to the contract, if that makes sense.
Yeah, it certainly does. So how is TPRM or third-party risk management being handled in companies? How do they go about it?
Yeah, third-party risk management, again, it's really early for a lot of organizations, and we've really seen three different market categories or segments in the market that kind of tangentially or more directly deal with third-party risk management. The first thing that you hear about is called TPRM, which is third-party risk management, and that tends to be an area where people focus more on the IT or cybersecurity controls that are in place that protect company data. So from those that are accessing, storing, or processing data in some way, right? So that's kind of one sort of pocket of individuals that will manage that. The other area or segment is around supply chain risk management, which tends to deal with more of the procurement or contract execution sorts of risks. And then you have compliance risk management, right? And so you have these different teams that typically deal with these different risks. And these different teams have different processes that look at the different aspects of third-party risks specific to their job function. So again, around security or procurement and audit. And unfortunately, many times these teams are acting independently. So they have different silos of solutions and processes, and they're not collaborating and harmonizing across the whole organization. So they're taking a very tactical approach to third-party risk management. And again, in addition to that, I think most organizations many of them using spreadsheets to do this, and many of them are relying on sort of annual assessments, right? But what we're finding now is more and more organizations are trying to take a step back, and they're trying to take a more strategic view on how they handle third-party risk management across multiple different departments, and how they can augment those point-in-time assessments with a continuous flow of information to make those better risk-based decisions throughout the contract execution time.
Yeah, so let's just clarify a little bit what the different areas of the organization are involved in the risk management.
Yeah, sure. So I think from our perspective, our background is more on the security side, and we typically, from a prevalent perspective, focus on CISOs, and the segment of the market that we typically deal with are the IT departments or security departments focusing on risks associated with IT vendors. And so these would be those that would be SaaS vendors and so on, they're accessing, storing, and processing data. And because of that, because they're very IT controls related, those tend to be owned by the security teams, right? So that would be the security team would be focusing on those sorts of risks. Procurement and supplier teams or supplier organizations might focus more on supply chain risk management. They're focusing a lot less on the IT risks, but more on the non-IT related risks. Those would be things like financial risks, performance risks, delivery, diversity, geopolitical. ESG is coming up quite a bit now, which is environmental and social governance is coming up quite a bit now. So they'll tend to focus on those particular risks. You also have sort of legal and compliance, looking for things that could impact maybe a breach of a compliance mandate somewhere that would result in some sort of penalty or fine. So they'll look at things like sanctions or politically exposed persons, state ownership with organizations, and those sorts of things. They may also tie into things like data privacy. So there's a lot of different regulations out there. NYDFS is sort of a New York State sort of a privacy regulation. GDPR is more of an international sort of privacy regulatory requirement. So you start to see some of these other different mandates coming up as well that'll be dealt with respect to the legal and compliance teams. So the different teams look at it in different ways, but I would say there's no uniform way that an organization manages it or controls it today. In fact, this is one of the challenges with third-party risk management in general. Every year we do a survey around third-party risk management, and we're just finding that it's a little bit mixed bag on who's taking ultimate responsibility. In the latest study that's available on our website at www.prevalent.net, we found that about 24% of the programs are owned by InfoSec teams, and that's typically because they focus on those IT risks, and the security teams are the best well-suited to understand and address those. About 24% of third-party risk management programs are owned by the broader risk management sort of organization. So it's sort of another project that they have within their broader responsibility area. About 20% fall into legal and compliance, and only about 12% fall into procurement. So different teams are handling it in different ways, but again, what we tend to see is it's managed by pockets of individuals using isolated processes and technologies, and the trend is for organizations to kind of harmonize that more strategically as they mature their programs over time.
So let's move on then and start applying this to credit management. And the question is, how best can credit managers then help these different risk management teams or the risk management team? And are there areas beyond financial risk where credit managers can be of assistance?
Yeah, I think, as I mentioned, I think one of the things that organizations are really striving towards is having that comprehensive risk profile of the third party. And I think if credit managers are using sort of their own calculus or deriving risks and metrics using, whether it's standard or proprietary analysis that they're using, their outputs of that analysis could always be fed back into a third-party risk program. It provides a unit of measurement or a facet of risk that should be considered when looking at sort of the broader risk brought forward by a third party. And not only can those risks be considered in context of other non-financial risks, but the insights from the credit managers can also be used to trigger and enforce consistent workflows across the internal departments as well. So if the credit manager sees something that they want sort of dug into, that could trigger a process that maybe the contracts team or the procurement team or the security team can actually use that as a trigger point to kind of dig in, if you will, to uncover or try to mitigate some risks that were raised by the credit managers.
Right. Credit managers are always looking for other areas to provide those triggers for themselves, so that's something they can share back.
Exactly.
Yeah. What are the best ways for credit managers to communicate risk factors then to the risk team?
Yeah, and again, that's the challenge. Is if it's done in a silo, all this rich information and outcomes that the risk teams are using, the credit managers are finding. If it's not shared, then it's not being leveraged as optimally as it could, right? So, I think if they have a separate process and a product, than what's being used by the broader third-party risk management program, then there could always be an integration point where those scores, so those high-level metrics and scores, can be shared back and integrated into that comprehensive risk profile. That would enable sort of the experience and the insights of those credit managers to be correlated with those other dimensions of risks that I mentioned earlier, and can trigger the more standardized, cross-team risk workflows. So again, if they see something happening from a credit perspective, it could trigger an interaction with the vendor in some way. It could be a security team, a procurement team, maybe it's something around the risk or legal teams, to actually interact with that third party and get ahead of the risks, right? To try to minimize the risks when they can. And they could leverage that third party program to track the risk mitigation over time as well. So I think there's a number of ways that they could do that integration, either manually or through automated integrations. Many of the providers for third-party risk management today do have very extensive APIs, and I think integrating across those products is certainly something that many companies are striving for.
Makes total sense. Let's dive into the data that third-party risk management teams are looking at. So you had mentioned already, that typically there's a periodic questionnaire-based risk assessment, but we've been talking about monitoring here and trigger events and things like that. So let me ask you about a couple of the areas that you've touched on as we go on, and you can give us a little more information about the risks that are being collected there. So let's start off with ESG, the environmental social governance.
Yeah, so again, as you mentioned, most organizations still use and rely on sort of those annual question-based sort of assessments, but complementing those with monitoring is certainly coming up more and more. What we have found is that over the past couple of years, organizations have kind of matured their program. Initially, they start their programs a lot of the time just looking at IT risks. I think the latest survey had about 45% of our respondents look at just IT risks, but we're certainly seeing non-IT risks coming up, more and more. And about 40% of our survey respondents indicate that they're starting to ensure their programs behind just the IT risks. Environment and social governance does come up quite a bit. I think that's driven a lot by investors and by the public demanding more responsibility of the businesses that they buy from. And so ESG scoring for public companies, it really offers an analyst-driven insights into the stance and the processes taken by the organization, right, with peer reviews and EPA violations and equity databases and so on. So, at Prevalent, we leverage a database from a company called Refinitiv, where they kind of provide a high-level score for how the company is behaving in each of those different areas: environmental, are they recycling, so forth; social governance, how they govern the relationships that they have with those third parties. So it's starting to come up more and more. But I would say it tends to be secondary to kind of some of the more IT-based and privacy-based controls that are within the scope of the program.
Okay, so let's talk about cyber risk. That's certainly going to have IT's interest.
Yeah, cyber risk certainly comes up more and more. I think a lot of organizations are becoming more aware of third-party risk management just due to the number of data breaches and ransomware outages and so on that are impacting them through their third parties, right? So again, you think over the last couple of years, Cove, SolarWinds, Kaseya, there's just been a number of third-party data breaches that are really kind of driving the awareness of this whole problem area. And when a breach happens, that's kind of the result. So if you can start to get ahead of that, like what are the indicators of compromise? What are the indicators of hygiene around an organization's cyber preparedness? And so companies like ours and others will monitor the third party externally. They'll look at things like criminal forums to understand hacker chatter, who's talking about the company, looking at leaked credentials on the deep web, dark web. Look at command and control sort of activities. Is there indicators that some of the servers within the digital footprint of a company have been compromised already? They'll take a look at external vulnerability scans and web-facing assets of a third party to understand if they're vulnerable to attack. So there's just a number of different, I think, signals that organizations can use to really understand the hygiene with respect to how a company is managing their cyber preparedness. And so monitoring that on an ongoing basis and making our customers aware of that, as opposed to waiting for that annual assessment, is certainly something that we're seeing more companies and more programs starting to adopt.
Does that get into their susceptibility to a breach? Because I think you can take a look at there's people that have data on servers and the type of servers and
that's right,
across the whole digital environment. Does it get into that type of thing?
Yeah, it would. So a lot of the time you'll look at a company and you'll look at their URLs, you'll build up a digital footprint of their web-facing assets, and then you'll inspect those for vulnerabilities. So are they vulnerable to the latest, SolarWinds or the latest code vulnerability? Sorry. So they'll look at those sorts of things, and they'll make you aware that there are some vulnerabilities out there that need to be minimized. Now, in some cases, they might have mitigating controls in place, but at least you can ask the question to make sure that they're aware of these things, that they're on top of it, and that they're doing something about it.
Right, and you're also going to be looking at prior hacks and data breaches and things like that.
Yeah, the other type of data that you can get, and a lot of people use that particular insight for onboarding of new third parties. So as you kind of go through that vendor relationship of selection to contracting to onboarding, one of the things that you may be interested in, as a credit manager is, credit manager or even a credit insurance underwriter is, what is the history of data breaches with this company? So, companies like ours will kind of feed you information on the last 10 years of data breaches associated with a particular company. What types of records were compromised, how many records were compromised. That kind of insight would be at your fingertips. And then, of course, you could monitor that organization for public disclosure of breaches moving forward. So again, you don't want to wait until you hear about it from someone else, but you can proactively be notified that there's been an issue with one of your third parties. Then you can immediately start putting some remediation and some resilience plans in place to minimize the impact.
Right, and that's something I've become aware of recently is the impact of that. The large companies, survive the data breaches, but was just impressed with the number of small companies that either default completely or get into financial distress when they have a data breach, and it's something like well over 50%. So that's
right.
That's interesting stuff. It's sort of scary as well.
Yeah, and we're finding more and more, of those survey respondents that I mentioned earlier, more and more are indicating that they have been impacted by a third-party breach in the last 12 months than previous records show. So we certainly see this as a significant weakness, if you will, for many organizations, is visibility over these supply chains.
Yeah, and then we also, I think we've mentioned business and financial information.
Yeah, and again, so if you take a look at sort of the business side of things, and that's just keeping up to date on kind of the pulse of what's going on with your third party estate. And so there's a lot of data out there. You have public websites, blogs, news articles, trade sites, those sorts of things. So how can you be aware on an ongoing basis of what's really kind of going on with your third party, right? So how do you identify and pinpoint any potential events of interest that are being discussed in the broader community? It could be things like financial declarations, mergers, operational changes. Could be legal probes, litigation. It could be outages that an organization's having, labor disputes could be another thing. And so, again, a lot of organizations will have different data feeds that will deduplicate this data, that will kind of categorize this data and make it readily available for consumption for different personas within the organization, including credit managers. Because many of these business impacts that you see, whether it's a labor dispute or an outage or something like that, it may be an early indicator for what you might see down the road with the financial analysis that you might be doing right in the next 6 months. So again, having that information earlier allows you to make faster, quicker decisions on reducing your exposure. Same thing with financials, right? So being able to monitor, on an ongoing basis, even the ratios, payment terms, credit scores, and those sorts of things. So just having all of this information collated into a comprehensive profile and fed to you proactively just helps you kind of keep pulse of those third parties and make more, I think, responsive corrective actions when needed.
Yeah, and I think we have one last area, reputational.
Yeah, reputational risks. Again, these would tend to be the types of risks or risk dimensions that would be focused on from more of a legal and compliance perspective, right? So you want to make sure that when you onboard a new party, you take a look at what's going on in Ukraine, for example, a lot of changes to the global sanctions list. So you want to be able to look at local sanctions and enforcement lists across the globe, including not just sanctions, but identifying politically exposed persons, state ownership, and so on. So those from whom maybe transactions are prohibitive. So you want to be able to monitor those on an ongoing basis as well, just to make sure you're not violating anything on an ongoing basis. And the challenge a lot of organizations have, of course, is they might look at that during the onboarding process. But once you've onboarded a third party, and again, some companies might have hundreds, thousands, tens of thousands of third parties. How are you making sure that you're complying with that on an ongoing basis? And so having that reputational insight monitored on a continuous basis throughout the terms of the contracts of those third parties you're doing business with is certainly something that we see organizations moving towards.
Yeah, so much is involved in this. The monitoring seems to me to be a really huge challenge.
It does, and again, having solutions in place and partners in place that can help you kind of unify the information, kind of elevate the information to a level of understanding, so you don't have to kind of dig into the details of everything. I think this level of monitoring certainly doesn't eliminate the need for the traditional financial analysis that we mentioned, but it certainly provides early insights into activities that can have a significant downstream impact on the financial and credit standing of a third party. Just like I mentioned for those indicators of compromise or their cyber hygiene could have a downstream could have an indicator for a potential downstream data breach. So if the company has a history of data breaches or is actively breached or has a massive outage or is in litigation or has a labor disruption in some way, would you want to be aware of that sooner rather than later? And again, third-party risk management is all about having this information so that it can be collated, summarized, and prioritized, and then proactively delivered to the appropriate credit managers and credit insurance underwriters, enabling quicker upfront decisions and more timely remediation. That could include things like tightening credit lines, tightening credit terms, or adjustments to credit insurance, for example. So again, more information is not always better, but having the right information at the right time certainly is something that I think would be of value to many organizations.
Right, and then that could be of value to the credit managers as well. So we started off asking, what can credit managers contribute to the third-party management, the third-party risk management team? Let's turn it around. How can, and specifically the cyber data and the sentiment or reputational data, help credit managers?
Yeah, so it's all about augmenting, I think the dimension of financial risk with these other areas of risk to have that comprehensive understanding of risk associated with a particular third party. So I think from a cyber perspective, a robust third party management program can provide information on the data breaches, as I mentioned earlier. So how what's the susceptibility for breaches moving forward? The current security hygiene associated with the third party, because again, if they're sloppy, if you will, from a security and compliance hygiene perspective, that may raise risks and contribute to your analysis. It can also, again, it really helps answer that question of how well the third party is protecting themselves, right? So I always look at it, if you think about the monitoring, think about it of an indicator of possible compromise or possible impact down the road. Some of the questions would be, talked about earlier, like how many public data breach disclosures have they had over the last 10, 15 years? How much data was compromised? A kind of a poor breach history could impact an organization's ability to deliver a service or pay its bills, or as you mentioned, or could impact its ability to be a going concern. And I think once onboarded, a third-party risk management program can automatically manage and monitor your third parties for ongoing data breaches to ensure that you have the appropriate remediation and mitigation strategies in place. So again, I think this is great information to have. It could be information that could be leveraged by credit managers, and it could be leveraged by credit insurance underwriters to look beyond the standard financial metrics. Right, and I think you could find same benefits for things like the business and reputational monitoring as well. You have continuous insights into business events that can impact the third party's ability to deliver a service or potentially a product in the future. Again, having early indications of layoffs or outages or disruptions and so forth could all allow you to kind of get ahead of things before it impacts the downstream financial statements. So again, I think it's valuable to kind of provide information to the credit managers, but equally, I think that the credit managers certainly have a lot of experience and understanding from a financial risk posture that could benefit the rest of the TPRM program as well.
Right, and we mentioned that ESG was emerging, but also you have EPA violations, and then environmental risk factors. As the customer located on the Gulf Coast and subject to hurricanes, or in California and subject to fires, fire, winds, and floods types events, and especially if they're recurring in multiple years, that adds up. So, I imagine this data would be useful in that way as well.
It would, yeah, and a lot of it, I think the prioritization of the different dimensions of risks are really, I think, dependent on the industry, right, and the type of kind of service or product that an organization is providing. I think every year, as I mentioned, we do a third-party risk management survey that's free and available on our website at www.prevalent.net. And each year, as I mentioned, we're seeing that the non-IT risks continue to increase in importance. So, they might start their program looking at IT vendors and looking at IT risks and cyber risks, but as they continue to grow and mature those programs, they start looking at some of the other risk metrics that you mentioned as well, right? So EPA violations, ESG scores, and so forth. And I think within that cohort of data that we collect on these third-party programs, I think that we're certainly seeing a bigger interest in business reputational ESG. It comes up quite a bit. Maybe I want to redo that one. I'm not sure if that was too wordy. So I'll stop there. Maybe I'll just say that ESG sourcing is a theme that's becoming more prominent. I would say that it's not on the highest of the priority list right now. On the highest, you certainly would have things like IT controls, privacy, and those sorts of things. But ESG is certainly increasing in priority. I think that's partly driven by the influx of data points being shared by organizations to demonstrate alignment to ESG guidelines and principles, and allowing a more standardized analysis of the sourcing process.
Yeah, this is all great stuff, Brad. Just to wrap things up here, just some closing thoughts that you might have on the ongoing monitoring and how credit management, can both benefit and contribute to that.
Yeah, as I mentioned, I think I think it's participating in the third-party program benefits everyone, both the credit managers and the other departments and individuals that have to interact with those third parties. I think for the benefits from a credit management perspective, I think would include a combination of proportionate insight into the business activity, as well as additional financial record visibility. Provides a snapshot of the broader organizational health. So you're looking at that comprehensive risk profile that I mentioned earlier, so you can start to take in consideration in your analysis things like the cyber risks and the breach histories and those sorts of things. And then ongoing monitoring can also extend itself to self-reported events from an organization that would otherwise be missed. So a lot of third-party programs have the facilities, if you will, that third parties can actually enter their own events. So if they've noticed that they had an outage or a breach or something like that, they can start to feed that information into the program to foster more collaboration and information sharing with the third parties. So I think that's certainly an area of benefit. I think credit managers can also contribute. I think that they have a wealth of experience and exposure to financial records that can be leveraged to enable them to educate those reviewing the third-party reports and provide guidance on potential risks and pitfalls of third parties. So again, when I look at organizations that are trying to harmonize, a lot of people in procurement and legal, and they don't understand the sort of security risks, so they look to the security team to help them understand that. Much the same if you have programs driven out of InfoSec, they might not understand the financial risks. So having someone there to help them understand that and to elevate that understanding is certainly, I think, a benefit that could be provided by having credit managers participate within the program.
Well, thank you, Brad. This has been extremely informative, and it's been a pleasure chatting with you. So we appreciate you joining us today, and thanks for coming.
Great. Thank you. Glad to be here.
We've come to the end. So this is Dave Schmidt for Credit Today, signing off.
Thank you, everybody, for tuning in. If you want to learn more on the topic, check out Highako.com. That's HIGHAKO